Regarding business picking, Buffett initiated the concept of economic moat and has been applying it throughout his investing practices. In the letter to shareholders of 2007, Buffett categorized companies as the great, the good, and the gruesome, based on whether a company has a moat and its width. 1. How Buffett recognizes a great company. In Buffett's view, a great business needs to have a sustainable advantage, and this advantage can be continuously converted into profits without continuous investment. Buffett referred See's Candies as the prototype of a great company. For that, See's has provided itself to be a valuable cash cow, with a strong brand effect as the economic moat. The company could increase profits by raising prices even when sales reach a plateau, and the process does not require reinvestment. A good company means that the company has advantages and can bring returns to investors after continuous investment. Citing Flight Safety International as an example, the company maintains its leading position in the industry by continuously upgrading its aircraft simulation pilot equipment and obtains certain returns. If the width of the moat cannot be maintained continuously, it will be difficult to resist the competition of other companies. The gruesome business requires significant capital to engender growth, and then get little or no returns. He took American Airlines, which he bought in 1989 as an example, when the American aviation industry was in a state of competition. The airlines were caught in a hopeless price war and suffered from losses for 15 out of 30 years. Buffett's moat concept believes that companies should have a certain monopoly resources to avoid excessive market competition, empower themselves with pricing power, and increase profits. 2. The role of manager. In addition, Buffett attaches great importance to the company's management, and he would spend a lot of time understanding and evaluating the management of the target company. Buffett requires that the manager of a good company should be good enough to marry his daughter with confidence. Specifically, there should be 3 qualities: being responsible to shareholders, being frank and thinking independently, but if a business requires a superstar to produce great results, the business itself cannot be deemed great. 3. To be a great batsman. At last, it's time to talk about when to invest. A reasonable price is defined by a company's intrinsic price and margin of safety. The principle of safety margin mainly means that the purchase price should be lower than the calculated intrinsic value, and a certain space should be kept to ensure the relative safety of investment. As the saying goes, paying too much for a company that's doing well financially must be a bad investment. In light of opportunities, Buffett believes that you don't have to swing every ball. He posted a poster of legendary baseball player Ted Williams in his office. Ted divided the batting order into 77 squares, each the size of a baseball. Only when the baseball flew into the best one of those squares would he swing at the ball. At that point, his hitting rate is as high as 40%. Whereas if the ball flies into the worst square within his ability, his hitting rate quickly drops to 23%. In other words, waiting for the good time and you can enter the Baseball Hall of Fame. If hitting every ball you see indiscriminately, you will only become an ordinary athlete. Buffett's partner, Munger, once said, "If we take out our 10 most successful investments, we are a joke." So Buffett's business picking formula is picking the best within your suitable circle of competence at a rational price. Got it?